Imagine one narrow shipping corridor changing gas prices, delivery costs, and even central bank decisions within days. That's where we are right now. On February 28, 2026, the U.S. and Israel launched a large-scale military operation against Iran. Iran responded with missile strikes targeting Israel and U.S.-linked assets across the Gulf region. Today, we'll break down what happened, why markets are reacting, and what this could mean for the global economy. From oil and logistics to inflation and stock markets, this is news analysis, not financial advice. Events are moving fast. Early on February 28th, reports described explosions across multiple Iranian locations, including Tehran. Officials framed the operation as potentially multi-day and aimed at degrading Iran's missile and nuclear capabilities. Another key point, the diplomatic track had just stalled, talks failed to produce a breakthrough, and the situation escalated sharply. Politically, the messaging quickly moved beyond limited strikes. Public statements signaled pressure for major internal change in Iran. And inside Iran, the backdrop matters. The country was already under severe economic strain, with prolonged internal unrest, and very high inflation reported over the prior months. Iran's response wasn't limited to one front. Reports said missiles targeted Israel and sites linked to U.S. presence, and partners in the Gulf region, places like Bahrain, Qatar, and the UAE. This is the critical escalation factor when bases, ports, airports, and energy infrastructure across multiple countries enter the equation. The economic impact isn't theoretical anymore. It changes insurance costs, shipping routes, and airline planning, and the price of risk across the entire region. Everyone is now looking at one specific location. Now, the big question, why is everyone talking about the Strait of Hormuz? Here's the simple version. The global oil market isn't only about how much oil is produced, it's also about whether it can be shipped. The Strait of Hormuz is one of the most vulnerable choke points on Earth. It is the artery of the global energy trade. Roughly 20 million barrels per day move through it in normal conditions, around 1/5 of global oil consumption. If the market believes that flow could be disrupted, prices can rise even before physical shortages show up. And importantly, alternatives are limited. There are pipelines that can bypass parts of the strait, but they don't replace the full volume. That's why even the risk of disruption carries a powerful price effect. It hits your wallet at the pump. Bottom line, if investors start pricing in supply could get stuck, oil goes up fast. Stay tuned as we watch this develop. Once oil jumps, the dominoes start falling. Oil gets more expensive because markets add a war risk premium. Even if supply isn't cut yet, expectations alone can move prices. Producers may respond. You can expect discussions about increasing output to stabilize markets and offset potential shortages. But even if production rises, expensive energy still filters into everything: shipping, aviation fuel, plastics and chemicals, manufacturing, and food logistics. That pushes inflation higher, adding further pressure to the global economy. And higher inflation affects interest rates. Central banks become less willing or less able to cut rates. If inflation reaccelerates, rates stay higher for longer. That pressures mortgages, consumer credit, business financing, and stock market valuations. This is how a regional conflict can turn into a global economic story. At the same time, logistics can take an immediate hit, sometimes faster than oil. Airlines often reroute or suspend flights to avoid conflict airspace. That means longer routes, higher fuel costs, and more cancellations. In practical terms, flights become less reliable and more expensive. Express delivery costs rise, shipping insurance increases, and global supply chains get slower and costlier. Even if the conflict is short, the cost of risk can linger, especially for freight, insurance, and routes that pass near the Gulf. To stay grounded, it helps to think in scenarios. Scenario A, quick de-escalation. If strikes remain limited and diplomacy resumes quickly, the oil risk premium can fade. Markets may stabilize, though insurance and security costs might remain elevated for a while. Scenario B, prolonged conflict and infrastructure damage. If this expands, especially if shipping lanes face serious disruption, or if key facilities like ports, terminals, and pipelines are damaged, oil can push into 100+ territory and the global economy risks a second inflation shock. In that scenario, stock markets can sell off, credit conditions tighten, and central banks stay restrictive longer than expected. If we summarize the world's dashboard right now, there are 4 indicators to watch. The Strait of Hormuz, any real disruption to shipping, insurance, or traffic flow changes everything. Oil prices and producer responses. Are major producers increasing output enough to offset the shock? Airspace and routing. How widespread are flight suspensions and reroutes? Flight to safety. In uncertain moments, gold and other safe havens can surge when fear rises. Final thought, even if fighting slows quickly, the price of risk can stick around. And that can mean higher logistics costs, more fragile supply chains, and markets that stay nervous longer than people expect. We will continue to track these developments. Make sure to subscribe for updates as this situation evolves. I'm your analyst. Thanks for watching.